Welcome to The Explainer, where we take on complex topics and break them down into presentations that are clear, engaging, and easy to follow.
Today, we're cracking open an analyst report from OCBC to give you an investor's look at China Aviation Oil, or CAO for short. Now, this is a real giant in the jet fuel industry, and it's basically the company that keeps the planes flying in one of the most dynamic aviation markets on the entire planet.
All right, so here's our flight plan. First, we'll get to know CAO and what they do. Then we'll look at their absolutely stellar performance last year. After that, we'll check out the opportunities and the risks on the horizon, and we'll wrap it all up with the analyst's final verdict.
So first up, who exactly is China Aviation Oil?
Well, the easiest way to think about them is like this. They're the main gas station for airplanes in one of the busiest, fastest-growing travel hubs in the world. They're not just a supplier. They are the single biggest trader of actual physical jet fuel in the whole Asia-Pacific region. And crucially, they're the key importer for China's enormous aviation industry.
Now, this chart really drives home just how critical China is to their business. I mean, look at that. A massive 57.5% of their revenue comes directly from China. This basically makes them a powerful proxy for the growth of Chinese air travel itself.
So, how did that market dominance translate into actual performance? Well, with global travel just roaring back to life, the 2025 fiscal year was, well, it was nothing short of exceptional for CAO. The numbers were so strong they blew past both the analysts' and the market's expectations.
First, just get a load of this number. A staggering 73.9% jump in gross profit. This tells you that their core business, supplying and trading fuel, became way more profitable, thanks to selling more fuel and some really smart trading. And that profitability, it flowed right down to the bottom line. Earnings per share, or EPS, which is a really critical metric for investors, it soared by over 41%. That means more profit for every single share of the company.
This little table really ties the whole story together beautifully. You can see healthy revenue growth right at the top, a huge 41.7% jump in net profit, and look at this, they even shared the wealth with investors, boosting the dividend by a full third. Just a fantastic year all around.
So a record year is great, but for investors, the big question is always the same. What's next? Where's the growth going to come from now? And here is the key takeaway, right here. CAO is sitting on an absolute mountain of cash. We're talking over $680 million with zero debt. This gives them a massive war chest to fund future growth, whether that means buying other companies or investing in totally new projects.
The analysts are seeing a few potential growth engines here. First, just the continued boom in Chinese travel. Second, using that big pile of cash for smart acquisitions or to buy back their own stock. And third, and this is a big one for the future, tapping into the growing market for sustainable aviation fuel, or SAF, as the world searches for greener ways to travel. But, of course, no investment is a sure thing. It's not all clear skies ahead, so we absolutely have to look at the potential turbulence for CAO.
So the main concerns that the report highlights are pretty clear. A surprise slowdown in travel would obviously hurt them. Geopolitical events can cause some crazy, unpredictable swings in oil prices. And here's the big one to watch. Any kind of regulatory change that could challenge their near monopoly on jet fuel imports into China. Geopolitical conflict is a perfect example of a complex risk. It really is a double-edged sword. On one hand, the wild swings in oil prices it creates can lead to some very profitable trading opportunities for a company like CAO. But on the other hand, if jet fuel prices get too high, it might just discourage people from flying, and that would hurt their sales volumes.
So, after carefully weighing the incredible performance, the future opportunities, and these potential risks, what is the final verdict from the OCBC analysts? What's the bottom line?
Well, they didn't exactly beat around the bush. The headline of their report was, and I'm not kidding, literally, to the moon. I mean, that signals some pretty serious confidence in where they think this company is headed.
And they backed up that incredible headline with a huge upgrade. They raised their fair value estimate for the stock by over 50%, from $1.60 all the way up to $2.48.
And with a significant valuation increase like that, it led directly to a clear, unambiguous upgrade of their official recommendation on the company to a buy. So what's the ultimate takeaway here? Well, the analysts don't just see a company that had a great year. They see a company that is fundamentally strong, is sitting on a huge pile of cash, and is perfectly positioned to ride that powerful wave of growing air travel in Asia, with plenty of ways to keep growing well into the future. And before we wrap up, just a quick and important disclaimer. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.